Welcome to another deep dive. Today, we're really getting into the latest earnings from a major force in cybersecurity, CrowdStrike Holdings, Inc. That's ticker CRWD. We're looking specifically at their Q2 results for fiscal year 2026.
That's right. And this isn't just about, skimming the press release headlines. We're aiming to go deeper, understand the context behind the raw numbers, and pull out those critical insights you really need.
Exactly. We've got a detailed analysis here, blending company data with market data, all structured in a clear framework we'll walk through. We're talking about a leader, maybe even a bellwether, in such a crucial industry. And these Q2 earnings, well, they show some fascinating contrasts, really highlights why digging in matters.
Indeed. It's always interesting how the official numbers tell one story. But when you layer in market expectations and use a structured approach, a much richer picture emerges. We'll explore the what, definitely, but also the why it matters for CrowdStrike this quarter and what it might suggest going forward.
Okay, sounds great. Let's get started. Now for slide 1, the at-a-glance scorecard. So this is our first quick look. CrowdStrike reported, well, a strong quarter on the top line, didn't they? Significant revenue growth, actually beat Wall Street expectations. Could you give us those headline figures?
Absolutely. So for Q2 FY26, total revenue came in at $1.17 billion. That's a pretty big jump from $963.9 million the same time last year. We're talking a solid 21.3% year-over-year growth. And crucially, that number beat the consensus estimate, which was around $1.15 billion. So definitely a revenue beat there.
Okay, so revenue looks great. Sounds like clear good news. But, the report flags a more complex situation on the profit side, especially with the GAAP net loss. This is where things get interesting, right? Walk us through that.
Yeah, this is where you see that divergence starting. While revenue was strong, the GAAP number that's generally accepted accounting principles showed a net loss attributable to common shareholders of $77.7 million, which is, well, a stark reversal from a GAAP net income of $47.0 million in Q2 last year. That's a decline of about 265.2%. Huge swing. And per share, it's a GAAP diluted net loss of 0.31 cents compared to earnings of 19.8 a year ago. Again, that's a drop of around 263%.
Wow, okay. That is a dramatic shift from profit to loss on a GAAP basis. But then at the same time, they reported a record non-GAAP diluted earnings per share, or EPS, of 93 cents. And that actually beat the Wall Street consensus of 0.83 cents. So how should someone, trying to understand their real performance, reconcile that? GAAP loss, non-GAAP beat.
Right. And this contrast is, well, it's pretty common in fast-growing tech companies, but it's absolutely critical to unpack. GAAP EPS includes certain expenses, often non-cash items like stock-based compensation, and sometimes one-off charges, which are then excluded from the non-GAAP calculation. The idea behind non-GAAP is to give a clearer view of the core, ongoing operational profitability, sort of stripping out the noise.
Okay.
So while that headline GAAP loss might raise eyebrows, the non-GAAP beat suggests the underlying operations are actually quite healthy. The market reaction was interesting too, a slight dip, about minus 0.38% right after the release. It reflects that mixed feeling, balancing the accounting loss against operational strength, maybe some valuation concerns too after the stock's run-up.
Got it. So the market didn't just ignore the GAAP figure. You mentioned this disparity between the strong revenue growth and that GAAP EPS decline. Is it purely down to those accounting differences, the non-GAAP adjustments, or are there other operational things driving it?
It's a bit of both, really, when you look at the bigger picture. It's not just accounting methods. A primary driver of that disparity was a big jump in GAAP operating expenses. They grew 36.3% year over year to $971.6 million. That growth outpaced revenue growth significantly.
Oh, okay.
And then there's the impact of share dilution. The number of shares used for the non-GAAP EPS calculation went up from about 251 million to 256 million. That's largely driven by stock-based compensation, which is, standard practice in tech to attract and keep talent.
Right.
So unlike companies doing buybacks to shrink the share count, CrowdStrike's growing share count actually worked against its per-share profit numbers this quarter.
That's a really key point for understanding tech financials. And emphasizing diluted EPS is important too, isn't it? Especially with stock options and things like that. It gives you that more conservative view, assuming all potential shares are out there.
Exactly. It reflects the potential full ownership picture.
All right, let's move on. Moving to slide 2, the engine of profitability. This section digs into how CrowdStrike actually turns that revenue into profit. The report mentions a slight dip in margins. What happened there?
Yeah, we saw a small decrease in gross margins. That's profitability on their sales before you account for operating expenses. GAAP subscription gross margin dipped slightly to 77%, down from 78% last year. And the total GAAP gross margin went from 75% down to 73%. Even on a non-GAAP basis, the subscription gross margin slipped a bit from 81% to 80%.
Okay.
It suggests, maybe slightly higher cost to deliver their services per dollar of revenue compared to last year.
Yeah.
A minor change, but noticeable.
A slight tightening there.
Yeah.
But the report really emphasizes that the most significant changes happened at the operating margin level. What's the story there? Especially with that big gap we talked about between GAAP and non-GAAP.
Yeah, this is really where the core of that GAAP loss story lies. The GAAP operating margin for the quarter was negative 10%. That's a sharp fall from positive 1% in Q2 last year. And even the non-GAAP operating margin, while still positive and healthy, did contract a bit from 25% down to 22%. But that huge difference between GAAP and non-GAAP, that's the most revealing part. And CrowdStrike's own release points out the key things they exclude from non-GAAP.
Okay, so what are those key exclusions? What exactly are they taking out to get from that GAAP loss to the non-GAAP profit?
Well, the biggest single item by far is stock-based compensation expense. That was a non-cash charge of $284.2 million this quarter.
Wow.
Yeah, huge number. Again, common for tech, used for employee incentives, but it hits GAAP profit hard. Then there's a smaller non-cash charge, about $7.6 million, for amortization of acquired intangible assets, basically accounting for past acquisitions over time.
Right.
But here's the really crucial part this quarter. There were two significant one-time charges that heavily impacted the GAAP number.
One-time charges. Okay, now this sounds really important for understanding the quarter properly. Tell us more.
Exactly. This is where a lot of that GAAP operating loss comes from. First, there was a charge of $35.7 million listed as costs associated with the July 19 incident and related matters. Their forward-looking statements clarify this relates to a software update issue that caused problems for some Windows users, and these are the costs to fix it, remediation costs.
Okay, I remember reading about that incident.
Right. And then second, there was an additional $38.4 million attributed to strategic plan-related charges, so restructuring or similar costs. You add those two up, that's over $74 million in expenses right there. And crucially, these are not part of their normal day-to-day recurring business operations.
Gotcha.
So that GAAP operating loss of $113 million, you can pretty much explain almost all of it by combining these large one-time charges with that ongoing large stock-based compensation expense. By excluding these unique non-recurring costs, they're trying to show, look, the underlying operational engine is still profitable and generating cash despite these temporary hits.
That makes a huge difference in interpretation. So for you listening, if you only saw the headline GAAP loss, you'd miss that a huge chunk came from these specific non-repeating events. That context is just vital for assessing how the core business is actually performing. It's like judging a restaurant's health during the week it had a kitchen fire, like you said.
Precisely.
Okay, let's shift gears now for slide 3, the engine room business segment performance. This is where we look at what's actually driving CrowdStrike's results day to day. Their model is heavily based on recurring subscription revenue, isn't it?
Absolutely. That's the core. If you look at the total revenue of $1.17 billion, the vast majority, $1.1 billion, came from subscriptions. That's about 94% of the total. And that subscription piece grew a strong 20% year over year, shows continued strong demand for their main cybersecurity platform.
And the rest?
The remaining $66.0 million came from professional services, things like consulting, incident response. And interestingly, that segment actually grew even faster, 44.7% year over year. While it's a smaller piece of the pie, that faster growth suggests customers are increasingly looking for their expertise maybe alongside the platform, often a good leading indicator.
Right. And for any subscription business, ARR, annual recurring revenue, is just such a critical metric, isn't it? How did that look?
ARR looked very healthy. It grew 20% year over year, reaching $4.66 billion by the end of Q2. But what's really significant, and something the CEO George Kurtz emphasized, was a record Q2 net new ARR of $221 million.
Net new ARR.
Exactly. He also mentioned a re-acceleration in growth happening a quarter ahead of our expectations. Focusing on net new ARR is powerful because it tells you growth isn't just coasting on renewals. It means they're actively winning new customers and selling more to existing ones at a strong clip. That re-acceleration directly counters some of the negativity you might infer from the GAAP loss. It points to real business momentum.
That's a great point. And that links into their land and expand strategy, right? Getting a foot in the door, then selling more services or modules. How does the report show that playing out?
Yeah, the module adoption rates really validate that strategy's success. It's quite impressive. As of quarter end, 48% of their customers were using 6 or more modules. That's almost half. Then 33% used 7 or more, and 23% used 8 or more modules.
Wow.
Those numbers are key indicators of customer stickiness. The more modules a customer adopts, the more deeply embedded CrowdStrike becomes in their whole security setup. It makes it much harder for customers to switch away, reduces churn, and obviously creates a clear path for more revenue from each customer over time. It really underlines the value they're providing with that unified platform, especially as companies try to consolidate the number of security vendors they use.
So the takeaway for you here is pretty clear. CrowdStrike isn't just selling point solutions. They're building this broad, integrated ecosystem that customers get locked into, which is a recipe for long-term, predictable revenue.
Exactly right.
Okay, moving along to slide 4, financial strength and shareholder rewards. We've covered the income statement, the business drivers. Now let's look at the balance sheet. What's the overall picture of CrowdStrike's financial health?
Overall, it looks very strong. As of July 31st, 2025, their balance sheet showed total assets of $9.29 billion. Total liabilities were $5.49 billion, leaving total stockholders' equity of $3.79 billion. But the really striking number here is their cash position. They reported a record cash and cash equivalents balance of almost $5 billion, $4.97 billion to be exact.
Nearly $5 billion in cash. That's quite a war chest.
It's a substantial war chest, yeah. And it's backed by strong cash generation. They produced $283.6 million in free cash flow just in this quarter.
That's impressive. So with that much cash, how does their debt look? Are they heavily leveraged?
That's the next logical question. Actually, no, they're not heavily leveraged at all. Their long-term debt stands at about $744.7 million. When you compare that to their large equity base, you get a very healthy debt-to-equity ratio of around 0.19.
Very low.
Extremely low. It signals minimal reliance on borrowing, gives them a great buffer against economic uncertainty and a ton of strategic flexibility. That cash isn't just sitting there, it's potential energy.
Right. It means they can make moves, R&D, acquisitions, weathering storms, without worrying too much about debt covenants or interest payments.
Precisely. It's a position of strength.
So for you, our listener, thinking about shareholder returns, we didn't see dividends mentioned or big share buybacks. With nearly $5 billion in cash, why aren't they returning more directly to shareholders right now?
Well, if you connect this to the bigger picture, for tech companies still firmly in their growth phase like CrowdStrike, the usual playbook is reinvestment, not direct returns. Their capital allocation strategy is focused squarely on fueling further growth. That record cash hoard is being used for organic stuff like R&D and sales expansion, but also for inorganic growth acquisitions.
Like the Onum acquisition.
Exactly. They recently announced the deal to acquire Onum Technology, Inc. That move is designed to enhance their product suite, bolster their position in observability and data management, and reinforce that trend of cybersecurity consolidation they're leading. So that strong balance sheet isn't just about looking good financially, it's actively enabling their future growth strategy through M&A.
Okay, last section now for slide 5. The road ahead management's outlook and key takeaways. After crunching all these numbers, what did management actually say about the future, and what are the main things we should take away from this whole analysis?
Management sounded pretty optimistic, actually. They provided positive guidance for both Q3 and the full fiscal year 2026. For Q3, they're expecting total revenue between $1.208 billion and $1.212 billion, and non-GAAP net income per share between 93 cents and 95. And for the full year, fiscal 2026, they're projecting total revenue of $4.75 billion to $4.81 billion, with non-GAAP EPS between $3.16 and $3.72. And their CFO, Burt Podbere, specifically mentioned having conviction in continued net new ARR acceleration for the back half of the fiscal year, citing strong execution, strong momentum.
That's definitely a confident tone from the leadership team. Okay, so let's boil it all down. What are the, say, 3 absolute key takeaways you want our listener to remember from this deep dive into CrowdStrike's quarter?
Right, let's synthesize. I think these 3 points capture the essence. 1, underlying strength is overcoming those short-term headwinds. That big beat on non-GAAP revenue, ARR, and EPS shows the core business is fundamentally strong. The GAAP loss was real, but heavily influenced by those large, specific one-time charges that temporarily masked solid operational profits and cash flow.
Okay, look past the headline GAAP loss. Got it.
2, the power of the platform is evident. Those high module adoption rates aren't just vanity metrics. They prove the land and expand model is working incredibly well. They're building a very sticky, durable business by getting deeper into customer systems, creating a clear path for future growth.
Platform stickiness is key. Makes sense.
And 3, They have a financial position built for strategic advantage. That massive cash balance and low debt gives them a huge edge. It lets them actively pursue acquisitions, like own them, to consolidate the market and strengthen their leadership. They can play offense.
Right. So for you, the listener, particularly if you're looking long-term, the story seems to be don't get spooked by the gap loss headline. This quarter actually shows a company investing heavily, reinforcing its market lead, with a fundamentally sound business model underneath. It really highlights why using a consistent framework to analyze these reports helps cut through the noise.
Absolutely. And it leaves us with an important question for you to think about. Considering CrowdStrike's clear strategy of investing heavily in growth acquisitions funded by cash, but also using stock-based compensation, which impacts GAAP, how might a potential future economic slowdown affect that balance? How would they navigate maintaining innovation and growth versus showing a clearer, more consistent path to GAAP profitability if budgets tighten everywhere? It's that classic growth versus profit tension. Something to watch.
And that wraps up our deep dive into CrowdStrike's Q2 FY26 earnings. We've tried to unpack the nuances, look at the drivers, and hopefully give you a much clearer picture of what's really going on beneath the surface numbers. Now, the usual reminders. Please remember, this report is for informational purposes only. It does not constitute financial, investment, legal, or tax advice.
That's right. All investment decisions should always be based on your own thorough research and ideally in consultation with a qualified financial professional.
And while we've made every effort to ensure accuracy using the company's release and public market data, no guarantee is provided. This report was generated by an artificial intelligence model integrating those data sources.
So please, verify all information independently before making any decisions based on it.
Like and subscribe to stockanalytics.ai. YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.